Good afternoon and welcome to the May version of Making Sense of the Markets with Chris Kerlow and Team LWC. Thank you to everyone for taking time out of your day to join us. If you have any questions during our presentation today, please write them in the chat and I will ask them to Chris if they are timely. Otherwise, we'll get back to you directly or address it in our next MSOM. This month's edition is titled May the Rates Be With You, where Chris will walk us through the latest on the markets, rate predictions, and the utility space. Take it away, Chris.
Thanks, Adam, and thank you everybody for joining or watching the replay online. As Adam mentioned, the title of this presentation is May the Rates Be With You. As all emphasis continues to be on central banks, both here in Canada as well as in the United States, and where their rate policy is going to take us. And that is driving both bonds and stocks, with bond yields kind of having a driving force on both sides of the border. Canada seems to be leading the way on the path to the first rate cut here in North America. We've seen our core inflation fall back down to that 2% level, headline inflation down to 2.9%. The drop in oil prices to their lowest level in the last 2 months has helped that, as we continue to discuss that oil does roll through the economy, pushing inflation higher. In March, we saw gasoline prices up and shelter costs up as well. Those tend to continue to be the main culprits in this rate hike battle that the central banks are dealing with. But central bank governor Tiff Macklem did share that he thinks that we are close to the first rate cut here in Canada, but it's unlikely that we see Canada diverge too much from our partners south of the border. I would expect 1, maximum 2 hikes before we saw the US move. Expectations in the United States did change this month when Jerome Powell had his latest press conference, alluding to the fact that, kind of a hike is off the table and that a cut will come at some point this year. We saw bond yields fall on that news, stock prices rally. This came coupled with a US jobs number that is finally starting to ease, printing 175,000 jobs in April, a sharp move lower from the 315 we saw in March, but still a fairly strong environment there. They do have that dual mandate, unlike we have here in Canada, of both inflation and unemployment. The unemployment rate does remain tepidly low, which would be a challenging reason for them to try to cut rates with that strong of a labor market in the United States of America. The goal of a soft landing, though, does seem to be in sight, and the potential of a no landing, a no economic pullback recession environment is certainly in the cards, which is an impressive balancing act that we've seen from the Federal Reserve in the United States. As I mentioned, that chance of a rate cut is still on the cards, with about 2 priced in before the end of this year. You could see that the central bank policy rate would go down to about 4.75%. And according to the bankers' acceptance notes, that there's about a 70% chance of a cut as early as June. That comes as GDP growth is starting to become a little bit more muted south of the border, but debt levels do remain high, with debt to GDP at 263%. There are fears that this will force the Fed to pay higher interest payments and issue more treasury securities, further fueling inflationary pressures, which would be another reason why they need to remain on the sidelines. But if the rest of the world is lowering, they would be battling a rising currency environment, something that we are monitoring quite closely and would potentially be making moves within our portfolios should we see further strength in the Canadian dollar, because we are seeing these economic divergences continue inside of the North American economy, and something that could impact the portfolios and where we're positioning client assets. Earnings, on the other hand, have shown to be quite strong. This is a thesis that we believe supports equity markets into 2025 and the balance of 24. We saw great surprises on the earnings side during the earnings season here in the United States, about to move into Canadian earnings season, hoping we see much of the same. And stocks are acting quite well to those earnings surprises, with the average beat helping push stock prices higher, as you can see in the stock on the bottom right. The S&P 500 and TSX did, however, have a down month in April, something we fortunately positioned portfolios for, adding a little bit of cash. We're now moving out the other side, it appears, with this rally we've seen so far in May. The go away in May thesis from a seasonality standpoint isn't something we're playing this year. We think that equity markets, after that recent bout of volatility, could be on the moves higher once again here. Materials and energy led the rally higher, which attributed to the Canadian outperformance over the S&P 500, playing a little bit of catch up as we have struggled to keep up with our compadres south of the border. And year over year, we saw the highest earnings growth since 2022 on a quarterly basis for the S&P 500. Encouraging sign, since a lot of this rally since October has been fueled strictly from multiple expansion, something we've talked about before, which is not the type of rallies we'd like to see in these portfolios. We'd rather see that earnings growth spurred rally. And despite that weakness in both the labor market and the manufacturing sector, which just slipped below 50 on the ISM non-manufacturing PMI employment index, is encouraging, because that's the type of thing actually that the Fed needs to see. It's almost bad news is good news out there when looking at the economic data, because it's going to allow those central banks to ease again. Again, these are one of the main things that we continue to focus on as it relates to how equities are going to perform and the sectors that we want to participate in. It is a tale of two economies south of the border, the haves and the have-nots, unfortunately. You can see this in the chart on the bottom left, with income growth since the pandemic negative in real terms for that bottom quartile of earners, and extremely positive for that top quartile. That has helped be supportive to things like the cruise stocks and other luxury type of opportunities, and not so well for the bottom type of stocks, things like the dollar stores, etc. We've actually pivoted out of Dollar Tree this month, moving into Meta, as we see an increase in online ad spending after a bit of a lull last year. That stock took a step back on their earnings report because of a lot of spending in the artificial intelligence paradigm, which we believe is actually going to provide future earnings growth into the future. That wage, or back to that kind of divergence of the tale of two economies, you are seeing a good wealth effect. Those that own stock portfolios in the United States are, feeling richer, but both the high end and the low end are not benefiting from that savings buildup anymore that we saw during the pandemic. You can see that in the chart on the bottom right. That has drifted back down below 2019 levels. So there really isn't that, safety net built back up, which can be a worry for investors that start to spend a little bit more, but don't have that fallback plan any longer. This is one of those behavioral biases that we've been talking about over the past several months. This wealth effect is something that has been proven through the behavioral science and economics departments across the world. And, one of the best ways to defend against it, again, is to both have a plan, stick to that plan, working with a trusted advisor, and understanding that, paper gains can go away just as quick as they came. So that's the bulk of the presentation for today. One of the opportunities that we are leaning into is the utility sector. It's trading at very low historical forward price to earnings multiples versus the market. We're showing that in the chart on the top right. And it is a huge beneficiary when rate cuts do come back into play. That's the chart on the bottom right. We kind of show that inverse relationship there. It's really primed for a period of outperformance. Electricity prices are continuing to rise with inflation, while natural gas remains suppressed. and utilities are obviously defensive. Even in an economic downturn, you'll still turn on the lights and heat your house. But the biggest opportunity we see is in the longer term. This move to artificial intelligence, electrification of cars is going to just demand more and more electricity, and our grid really was not designed for it. So it is going to take these utility companies the build out of their infrastructure and increasing in turn their revenues to support that changing environment. Add to that increased in manufacturing from onshoring here in North America. That's the transition away from importing from other countries like China and India and the emerging world to building here at home. Couple that with the AI build out where there's a ton of electricity needed for that. We think it's a great sector and one that we're moving more heavily into.